Roundtable. I'm your host, Bill Priestley, and today we're going to take a little bit of a different road than we normally do. We're going to talk about earnings reports, especially those Q1 earnings reports that have been coming out on those earnings calls, and kind of take a different translation to that into the freight industry. And joining me now, come on in here, Anthony. We've got Tony Mulvey, one of our senior analysts, and of course, our chief economist, Mr. Anthony Smith. And we're going to take a look at some of these first quarter earnings, and you really can't start this segment off without talking about Target, unfortunately. So as we move through these charts, go ahead and throw the first one up. Target CEO underestimated the transportation costs here of what they tried to, what they were trying to do. This was obviously an oversight on their part, perhaps, but go into what went in here.
Yeah, I mean, Brian Cornell came out and said they're expecting $1 billion incremental transportation costs. And this is at the same time, so that's through the rest of the year. And what you're seeing in the market is this softening period. So it's kind of like they're saying this, but the market's showing signs of other things. So it's almost like, is this like we're overshooting our estimate and then going to deliver with lower costs, which ultimately affects their bottom line in a positive way. But it seemed like in their first quarter, they kind of ended up overpaying as well because their costs came in higher than what they expected, even on higher expectations coming into the year. So it's kind of the first quarter was kind of a surprise, and now they've basically blown those expectations through to the rest of the year, and now you're dealing with they're going to reap some benefits of softening in the back half.
Yeah, and I should say here at the start that we've got a rather broad cross-section of things that are going on as far as the things that we've picked up here on. Walmart coming right after that, inventory levels up 32% year over year. Another, they're again pushing stuff right into their warehouses.
Yeah, I'll start this one and let Anthony kind of talk about the broader inventories. But I mean, Doug McMillon on their call came out and kind of said, hey, we like having higher inventory levels because they didn't like being where they were left in 2020 and 2021 with these thin inventory levels, but that 30+% is too high. And that's not what they're looking for, but they are happy with a little bit higher inventory levels. I mean, you could probably talk to inventory levels a little broader.
Definitely. So inventory levels is something that we were talking to beginning of 2022, really the end of 2021 when we're looking at December, especially upstream inventory levels. And this is going to be something that's concerning because when we're looking at warehouse space, that's another area that's getting really expensive. And of course, inflation still very much being a thing here. You're looking at these producers like Walmart, like Target, really being eaten up by inflation. Some of those costs get passed along, but their inflationary pressures are outpacing the consumer inflationary pressures right now. So this is another area where they're going to be taking a monetary hit.
Moving on, let's move on to the dollar stores, Dollar General, and then saying the quote here is a little bit truncated, so let me read the extent of this. He said, we're starting to see that our core customers start to shop more intentionally, and we're starting to see that our next tier of customers are starting to shop with us a little bit more as well. That's Todd Vasos, the CEO of Dollar General. In other words, they're starting to see a different customer now, so they're doing things a little bit differently.
Yeah, and it's not really a surprise. I mean, as Anthony just alluded to, those inflationary pressures that the customer are facing, stores like Dollar General and Dollar Tree, when you had all the stimulus packages and things like that back in 2020, 2021, they were still dealing with the same their similar customer base. They were still there. Well, now inflation's eating into everybody else's pocketbook, kind of your money doesn't go as far, obviously. Right. So Dollar General and Dollar Tree, both of those options are a little more viable for a consumer that's living closer to that paycheck to paycheck.
And you see that what Dollar Tree came out, they're opening 590 new stores, adding more goods. They're, again, as you mentioned, between $1 and $5, a little bit lower tier there that anybody can get a hold of. Moving on, Costco. We are purposely building inventory in our e-com business, primarily in big and bulky categories. That tells me that they're looking at spending a lot of money in freight with those big and bulky items.
I think so. And I think what's interesting, and Anthony, maybe you could talk to it, it seems like big and bulky isn't what the consumer is going to be buying moving forward. So this one kind of confuses me as to why they may be building those inventories of big and bulky. I mean, we talk about furniture and things like that as being that big and bulky, but people have bought furniture throughout the pandemic.
Sure.
How much do you need to buy moving forward into this inflationary period?
And also, we're talking about, we're moving into summer where you're talking about buying services and traveling there as well. American Eagle, total inventory units are up 24% due to higher in-transit and on-hand inventory. So they're very good at looking at in terms of getting the goods into where they need to be, especially at that point of sale.
Yeah, and again, it's the broad theme is higher inventories across the board, and
Yeah.
I think that's the big takeaway. And what do inventory levels mean for transportation companies? And it's not necessarily the greatest. High inventory levels for transportation aren't great because things aren't moving, or if they are, they're moving by rail, or they're sitting at the ports. And I think it was yesterday on FreightWaves Now talking about maybe instituting those demurrage charges at the ports again because containers are starting to pile up. Well, it's because there's nowhere for it to go into these warehouses. They're full. They don't want to take the inventory onto their books because you look, 24% here, Walmart 32, Target 41. I mean, these are massive inventory levels that they're bringing on. And I think the important thing to remember about inventory is by value, not by actual number of goods. So I think there's inflationary pressures that kind of prop up those inventory levels compared to what true inventory levels, but there's this shift that we've seen in bringing in more goods for that just in case as opposed to just in time.
I think that's a great point, that just in case aspect, especially when you look at things like Costco, wanting to have those big bulky items on hand just in case, because you've heard some of the horror stories, I'm sure, throughout the beginning of the pandemic. I've been waiting on my couch for, 5 months now, and it's still not here, and it's now, backlogged, all these other things. So I think some of these producers have been burned, and they don't want to get burned again on not having some of those things on hand. The other big part that feeds into some of the bigger, bulkier items like furniture is going to be housing and construction. There was a big pull forward for that. It's going to be a little bit of softening now because, increased mortgage rates. So that's going to be an interesting area to see if some of that really actually benefits them or if they're going to be sitting on too much inventory.
Moving on, let's hit Dick's Sporting Goods. And this is, and Anthony, you can probably talk to this as well. They're talking about, on the apparel side, we did have some inventory challenges during the quarter, just making sure they have the right product and the right season product in stock. They're trying to make sure that, obviously people are perhaps a little bit indecisive, especially in what they want to do over the summer because there isn't that much money in what they want to put out on the floor to make sure the right product sells.
And I think this kind of comes back to even some parts of American Eagle. When you look at on apparel stuff, of the right season is going to be a big fit because you have some of those outlets like Ross and TJ Maxx where you can get some great deals. Sports is a whole nother arena. So you're looking at, all right, it's hockey season. I need my stuff for hockey. Or it's football season. I need to start gearing up. I need my mouthpiece. Or maybe it's track season. I need track cleats or spikes, I should say. So this is going to be much more critical for the timing of throughout the different seasonal trends. And so I think they're going to have a difficult one here because they're going to need to make sure that they have enough and enough of the right stuff. Sitting on the wrong type of inventory here can definitely be detrimental for them.
Yeah, that would be,
Just to add on, they talked about their inventories levels as a whole up 40%, but they're like, that's healthy because they need it because of all the seasons that they deal with. But on the apparel side, definitely that seasonal aspect. And that's kind of the concern that I have with, say, lockdowns in Shanghai and things like that is, are those goods that have been basically shut down for 2 months, are they going to make, if they're seasonal, are they going to make their season?
And then, of course, you have to worry about the consumer in that particular case where you have, say, someone who doesn't have that much money but may want to buy off-season when the prices are lower. They've got to be ready for that consumer there as well. Apple coming out, and Tim Cook, their CEO, basically making a very strong line towards their freight movement. Freight is a huge challenge in today, both from an inflationary point of view and from an availability point of view. From a company that has so much consumer loyalty, this is something that's interesting to hear from Apple.
Yeah, and you have to think about how Apple would move their products. It's really heavy air cargo and things like that because air cargo, high value, it's more secure. You don't have you're at an airport, right?
Yeah.
So it's obviously just the transit from airport to DC or to retail location, things like that. But air cargo is still really expensive. And I think that's the big key is they're fighting with everybody else that's missing seasons on the shipping on the ocean side with the lockdowns and things like that out of China. To now they're competing with that capacity, and that's going to ultimately be kind of one of those drivers of cost for them.
Staying in the technological world, Best Buy, with their earnings report, comparable online sales were down 14.9% year over year. Not good, necessarily. Anthony?
Yeah, so this one is going to be an area where it's like we've seen from retail sales, some in-store purchasing did increase over the last few months. So there was a bit of a shift from there, especially when you look at year over year, what was going on throughout the pandemic. But definitely this is going to be one of those areas where you want to keep supporting. And so I'm going to be watching closely for, of course, Christmas in July, Amazon Prime Day, other e-commerce holidays will follow suit here. So how much of a push forward will there be and really kind of trying to offset some of this excess inventory that they were building up for some areas, maybe Best Buy, Target, everyone will be competing in this area. But this is going to be one where I watch closely for how hard they're going to push for that e-commerce side.
Let's close out with three players in the freight market. J.B. Hunt, with Darren Field, their president of Intermodal, saying we have more demand from customers than we currently have capacity to serve. That sounds like a good yet also frightening thing to say to competitors.
Well, it goes into this elevated inventory level, right?
Yeah.
It's intermodal sets itself apart or plays really well when inventories are high and you don't need that time aspect. I think that, and it'll play into another one that we're seeing at the end, Union Pacific, but you're seeing these, they act as moving warehouses, right? If warehouses are bursting at the seams and you don't need the goods immediately, hey, maybe it makes sense to use intermodal compared to truckload.
Staying on the roads, Knight-Swift adjusted truckload offering ratio 70.2%. That's 360 basis points better than 2021. Obviously, this isn't hurting the big boys much at all.
No, not yet. And that was the key, was the first quarter was still pretty good. Throughout the entire quarter, I mean, March was really where you saw it start to decline, but the big boys they're still reaping some benefits of those higher contracted rates.
And jumping to the rails quickly here, Union Pacific intermodal volumes down 10% as our international volumes remain soft and are down 20% to start the quarter. That's Jennifer Hamann, EVP and CFO.
Yeah, I mean, intermodal, two distinct markets, domestic and international. Domestic being J.B. Hunt, international, you're seeing softness as people are trying to get their containers back across the sea.
One quick takeaway from each of you on how perhaps the freight industry should react to some of this.
I think if you're a truckload carrier, high inventories levels should concern you. You definitely don't want to necessarily see, you'd like to see more normalization, right? 30, 40% year over year inventory levels just isn't sustainable.
It might be a little bit, maybe it's a bit too much on my end, but consume more FreightWaves content because we were talking about a lot of this stuff really coming on and throughout the beginning of the year. So I think this caught a lot of people off guard, unsurprisingly to us. So I think consume more FreightWaves.
All right. Well, that's certainly good advice for everybody. We'll take a short break here. Thank you, gentlemen, for our roundtable. We'll come back and wrap up our show right after this break.